Good day, fellow investors. Let's discuss asset classes for 2023. And not just asset classes, but also if something doesn't work, let's look for the alternative and the solution. I think that will give you the best value. So let's immediately hit it with stocks. One of the best sources for stocks when it comes to the market and everything is the GMO, Jeremy Grantham asset class real return forecast. And this is from last year, 2021, and I thought, why don't we take it and see how things have changed as prices have also significantly changed over the last year. And now, stocks from returning negative returns over time, now that stocks are down, we are already almost into positive real returns, but still negative for US small caps. So in general, US still the most expensive market out there. International has gone from a slightly negative 7-year return per year, real terms that's adjusted for inflation, to positivity 3 and 5%. That's already something. Emerging markets went down, thus from 2% real return positive to 7%, and value that crashed like everything else over the last 12 months is now at 10.4% compared to last year's 5.7%. So, of course, as stock prices are lower, returns are automatically, mathematically higher, which is a positive if you want to invest in 2023. If you invested last year, well, as it was discussed also last year here, you should have expected negative returns, thus a decline in stocks. Nothing wrong there. Now, let's put this into fundamental perspective, also explain what this means, and then see, okay, what is the outlook and what is the best approach when it comes to investing in the stock market or into individual stocks. The key factor that changed over the last year is earnings. So earnings per share, this is for the S&P 500. They calculate all the earnings and then put it into an earnings per share estimation for the next 12 months. The source here is Earnings Insight from FactSet. Now, they always look forward, and you can see here that the earnings for 2022, the planned ones in 2021, were 240. However, now we are already looking at lower earnings, and the forward earnings are 230. This is again a little bit too exuberant. Typically Wall Street, 230 earnings for 2023. They have adjusted the 2022 projections final to 220, but things aren't that real. So the projections for 2023 from a year ago were earnings of 250, and now those are 231. I have downloaded the projections from April 29, 2022, and you can see that the forward earnings were expecting 250 EPS for the S&P 500. This is adjusted into S&P 500 points. And that is still good, 250, 230, all looks great. And then you say, okay, stocks are relatively cheap. If you look at the forward P ratio of 17, that is on the lower range for the last years. Thus, you might say, okay, stocks are cheap and thus a buy. But keep in mind, this is Wall Street, this is forward earnings, this is always expectations. And when we did the margin of safety summary, we learned that Wall Street's bias is always bullish. The reality is that the real earnings per share of the S&P 500, this is from Professor Schiller, is 193. That's not 250 as they are projecting, or 230, but the reality is 193 when you adjust for things, for losses, impairments, and everything. These are the real earnings, and this changes everything, because if we look at the P ratio with 193, the price to earnings ratio is 20. Now, let's estimate the long-term returns here. 100 divided by the price earnings ratio is 5%. If there is, like it was in the past, historical earnings growth of 2%, you get to 7% returns, where you have to also include inflation, increased prices, increased costs. And if inflation is 5%, then the real return is likely around 2%. This was made October. I think stocks are a little bit lower now. So there you are, from 0 1%. It's very delicate. If you think it's too much, this line is 15. So many times in history it was higher, lower, but 15 is the historical average. So that's the mean towards everything will go over time. There will be long periods of higher P ratios, but also lower P ratios in the future. And if we have a lower P ratio, then we have everything lower by 25%, which is a big, big decline if you want to look at what can happen to the stock market going forward. And this is really temporarily possible to see the stock market go down another 25%. But if there is a recession and everything, and earnings also decline to 153, if you think that's so crazy, 150, 160 are 2018, 2019 earnings, and those were even lower just a few years ago, before the stimulus boom that has really helped earnings and, of course, lower taxes. So we are not far from that possibility. If we look at stocks, those are definitely better now than in 2022. There is still some risks, as we have explained, but compared to alternatives, if you have a 7% student debt loan mortgage or something like that, when it comes to risk and reward, down payment or paying down this thing is much safer, much better than just investing blindly in stocks. So when it comes to the stock market in general or index funds, what can an investor expect? In the short term, 2023, I feel that, of course, things can turn for the better, especially if the Fed pivots, says lower rates, inflation subdues, and the liquidity remains there. We can easily go back to 4,500 and perhaps even higher. However, there is also the possibility of flat and also, as we discussed, of a decline. So I would say that there is a 30% chance for a crash from here, plus 20, plus 25, 30% down, a 20% chance for things going 20% higher, and let's say a 50% chance of staying flat 10, 15, 20% down over the next 12 months. Thus, the chances are skewed towards negative returns for next year. However, stocks, as they say, always go up. So if earnings go from the current 192 slowly and steadily, a few percentages per year, to 285, if the P ratio is 20 7 years from now, then you have a 5,700 level for the S&P 500, which is a few percentage points plus the dividend, so you get some return. Nothing stellar, but also nothing too bad. But there is something very important that I want to show you here, and the first fact is that over the last 40 years, stocks have been going nothing but up. We had this little break here of a decade where stocks went nowhere with two crashes after the 1990s exuberance. Look at this. For the last 10 years, this is a rocket going higher and higher. So the exuberance has likely passed, and therefore, if you look at the stock market, you have to have a longer horizon than 10 years to expect some significant benefits. It is a great time to accumulate, especially if it goes lower. You own businesses, great businesses, nothing wrong there. But to expect this again over the next decade is something closer to science fiction than to other. Yes, we are a little bit down, but actually we are just back to where we were a year and a half ago. So nothing spectacular there. And we are also much higher than the pre-pandemic situation. Stocks are still high and with a slightly negative outlook there. So what is the solution? I believe that the solution, given that the stock market is down, but many individual names in the stock market are down much more than 25%, which means that if you go and look through the individual businesses, you might find some value that fits your investment needs so that you don't have to invest into an investment vehicle like the index fund that is skewed towards negative real returns in the coming 5-10 years. If you look at businesses, if you learn about investing now, it is the opportunity to invest into single names, and we'll even discuss one that will summarize also this topic and the asset class overview later in the video. Because if you look at an index fund, if you look at the top names, Apple, Microsoft, all the best and most expensive names are at the top. So if you are buying now, you are buying more of the expensive and less of the things that might be cheap. If we just look, Facebook, for example, it was at the top of the list just a while ago, and now that the stock is crashed, so has the level that it is on the S&P 500. Thus, now that the stock is lower, you are buying much less of it than earlier when the stock was higher. And you can see it here when Facebook's market cap was above 1 trillion, then it was in the top of the S&P 500, top 5, I think, if I remember well. Now it is number 22. And also others, the FANG stocks that were so cool back then, Netflix, close to the top. Now it is number 56. IBM, that was also close to the top 10 years ago, 20 years ago. Now it is number 57. So by thinking about the risk and reward and the price paid, I think that you can find better solutions for your investing. And that's also something we do here on the channel. So on stocks, selection of good businesses at a fair price looks better now than markets, risk and reward. This is the conclusion from just looking at the data, and let me know if you disagree with me. To follow those businesses and learn more about businesses, I have started this YouTube educational portfolio where we update on earnings, we buy it, sizing, which reflects a little bit what I do for myself all the time, but this is with a little bit more cooler stocks to just introduce people on YouTube into how a stock portfolio can be managed over time. And perhaps the most important thing when it comes to investing in stocks and something to understand, and if you can understand this, then you will do extremely well financially over time. The key thing is that volatility is not risk. And we will explain that also through these other asset classes, because I have no idea where stocks will go in the next 12 months. But I know that if those go lower, I'm happier because I can buy more, reinvest the dividends, and simply accumulate wealth over time. But there is a difference between knowing what the value is and what the price is of something. Stocks go up and down, and few can tolerate buying something and then seeing it go down 30, 40, 50%. Even if that might be only temporarily, especially if you bought value here, then it goes lower, then you know it is temporarily. But as people cannot stand that volatility, they like to invest in other asset classes that are even worse. Let's discuss bonds, for example, that are absolutely terrible, terrible, terrible investments. Now, if we look at the returns on bonds, yes, zero returns expected over the next 7 years. International bonds a little bit lower, hedged, emerging debt, okay, but you are still investing in emerging markets, currency risks, and everything. US inflation linked bonds protect you from inflation, and cash, depending on the return you get from your bank, and if inflation goes down, should give you 1% return. So, the terrible there is that it does nothing for you. Asset managers, Wall Street like to sell those bonds because that's their business. Businesses want to borrow money, and that is what it is, but I don't see a benefit there. And if you look at the total real returns for the last 200 years from Stocks for the Long Run by Jeremy Siegel, you see that stocks do the best. So $1 invested is 755,000 compared to $1 invested in bonds is 1,000. So yes, there is a return, but not a great return. And don't get confused by the last 40 years. So bonds have done well because interest rates just went down. So when interest rates go down, bonds do well. But when interest rates are flattish or going up, bonds give you absolutely no real returns. So we can be looking forward at a period of 40 years where bonds don't create wealth for you. So positive times, here there was inflation, deflation, so there were higher yields on bonds. But now with high yields, with a yield of 6% and inflation of 2%, yes, you get a 4% real return, which is not bad. But with a yield of 3.5% and inflation at 7%, like we have now for the 10-year treasury, it is not a positive long-term return. So what's the solution here? Well, there are two solutions. First is accept volatility. If you can accept the volatility of stocks, you simply get to better returns over time because you own businesses, and those businesses benefit long term from inflation, or at least protect you from inflation, and therefore you get to real returns, unlike bonds that for very long periods of time might do very, very bad. Now, the second solution is, okay, volatility on one side, but if you need short-term cash, then yes, bonds. But keep in mind, Warren Buffett has about 100 billion sitting in bonds, but the average maturity of those bonds is 4 months. He is always buying those treasuries and then buying them again as they mature, and he's keeping them in short term because then he can use them wherever he wants, and the value that he owns is not impacted by interest rates, because as interest rates go higher, the value of longer term dated bonds at that moment in time goes lower. Because if you buy a bond at 2% and then the required yield from the market goes up to 4%, then if you pay the 1,000, the value of that bond now is 500. So that is the issue with bonds, the risk and reward. My simple idea is that one should not own long-term bonds except in the case when interest rates are 20% and it's very likely that long-term inflation will be lower. We have no idea where will inflation go, where will interest rates go. Thus, bonds are now much better at 4% than last year at 0, but still too risky for my taste. Okay, let's see if we can find protection in gold. The problem with gold is that it doesn't produce anything, and therefore the price of gold depends always on sentiment. Sentiment with gold can be great. Yes, you can forex your money when sentiment is great, but you can also go into despair for 2 3 decades when sentiment is bad. And since the last time that sentiment was great a decade ago, we have had now this jump here. But apart from this jump, very short time, for the last year, 2 year, 3 years, gold hasn't been doing great. The problem is that this is an asset and not cash flow. And if you want to protect yourself from inflation, you need to have assets that produce cash flow. And gold doesn't produce anything, and it's driven by sentiment. So you have to see whether betting on this fits you. And then you say, okay, yes, but the Fed is going to print more money. But look at this, gold has peaked in 2011 here, and in 2011 the Fed's balance sheet was at 2 trillion. Then they increased it to 4 trillion, 4 and something in the next 3 4 years. In that moment in time, gold actually went from close to 2k to 1, so down almost 50%, while the Fed's balance sheet went 2x. That's something that tells you, okay, this is just sentiment. Gold suddenly became cool again, and now it's not that cool. Whether gold will go to 4,000 or to 1,000 or 1,500 next, I have no idea, and actually nobody knows. If somebody knows, run away from that person. So the truth is that nobody knows, and I don't know. I see no point if you can accept volatility, because even in bad times, the price of gold depends on liquidity and demand and supply for gold. If people don't rush to gold, then it won't go up, and you never know. There is always a risk, and if you look at gold, it's even worse than bonds. Yes, you have these spikes here and there where you do okay, but you have also very long periods where you do badly. And what's next, I don't know. To discuss the Ray Dalio all-weather investment strategy and to make some money if you must have gold in your portfolio, we have added Newmont to our YouTube educational portfolio. It pays a dividend, and also if the stock price goes lower, I buy more. If it goes higher, I trim the position. And there, with the dividend and the trading around the volatility, I get to yield. It's not stellar, but it looks much better than just sticking to gold into one's portfolio, and you can follow that over time, which is another idea. So as you can see, there is always volatility here, and then every 20-30% you say, okay, I'm going to have 3% in a minor like this, and then if that becomes 5% of your portfolio, trim it back to 3%. If that becomes 2%, you bring it back to 3% or something like that. There is much more volatility because of the margins here when it comes to miners, so that's something you might want to look at. Plus, they pay a dividend that a bar of gold doesn't do, which is then also interesting. So a lot to learn there, and yes, you can do something good, but you have to see how it fits you. Now, gold, similar to crypto that was so loved a year ago, and now it seems that most people hate it and they have lost money there. But let's check it out now. So crypto had boomed, then it went bust, then it boomed again as stimulus and everything kicked in, and now as that is rewinding itself, we are seeing big decline. The fact with crypto this moment in time that the investing strategy is the greater fool strategy. So you are buying something thinking that for some reason someone in the future will be happy to pay more. And that worked here, that worked here. However, that is pure gambling, and the result is this. Even this, if you are playing with the wrong guys, and therefore the issue is that It is extremely risky. Nobody knows where it will go. Yes, it will change the world, is what the crypto bulls are telling me and have been telling me for the last 7 years. Okay, good luck with that. I'm still okay. Whatever happens there, I will doing my investing, and therefore I'll see. The biggest risk for crypto that I see is that this map here is free. And if you want to go around Los Angeles, you simply take your phone and you go wherever you want, and there are no friction costs, there is nothing. And I think that the same technology, blockchain, will be frictionless provided by someone. So that's the biggest risk I see with crypto coins and the speculation there. Plus, it's really a sketchy environment, has been for the last few years. Therefore, better to avoid. And from a sentiment perspective, from a flow of funds perspective, if people keep on selling in desperation, then it will go even lower. And why would you buy something where there is so much pressure on the negative? Maybe it will rebound, but the long term trend is pretty clear if it doesn't get traction and real usage somewhere that for now we still don't see. Now, real estate. Prices are not down yet, but interest rates are up, loans cost much, much more, and there is inflation, which are the factors to look when it comes to real estate. So, if we look at prices, you have to understand that real estate prices move slowly. So, we have had the great financial crisis, and then prices have slowly over 5 years went down. Then interest rates went to zero, were at zero, and then of course asset prices boomed. But now we have just started to see what might be a longer term decline in real estate prices. And when those start to decline, some of those, like commercial real estates, really can crash in a quarter or over the longer period, because interest rates are the key factor when it comes to real estate, and prices don't reflect reality yet. When you look at prices, I think that if interest rates remain higher, there is still a long way to go. And with 30-year mortgages now at 6.31% compared to 3.5 or 2.5 just earlier, that then this 2.5 very cheap money made the real estate price explosion. The situation for real estate now is really risky. I'm talking about real estate in general. There is always opportunity if you select one of 100 opportunities there. You know what you're doing, you know to select the right market, the right place, you know how to select the right opportunity. But I'm always thinking, I was always positive about real estate. If you can find a good deal, structure a good loan, then great. But now with 6-7% the cost of mortgages and real estate prices already inflected after the boom, I think that we might see there what happened to stocks. The fact is that with real estate, there is always this big lag after stocks. And just look at how much it costs now to buy a $500,000 house. So $500,000 with 2.5 interest rate or with 7.5. 2.5 is 1,000, 2,000 per month. This is 3.5 thousand. This is an insane price difference. And therefore, with higher interest rates, to pay the same monthly amount, this should be around 300K. That's a huge decline. That's 40% down in prices to justify the higher interest rate. And also, when it comes to REITs, I've been saying that it doesn't pay to invest in REITs with interest rates going higher, and I was pretty okay there. The Vanguard Real Estate Fund went nowhere for 5 years, so just dividends was the return there. Because yes, interest rates, but then also keep in mind, investing in real estate depends on the property, on the loan structure, and the calculations of cash flows. If you can borrow for fixed 1,000 and your long term with vacancies and everything income is 1,200, you make money over the long term. But you have to know what you are doing. And this was a very nice comment from the Netherlands. 90% of my wealth is in real estate, but now I'm thinking REITs might be a better alternative because of the hassle, because of taxes and everything. And everyone is now thinking about REITs. And then I'm saying, so you know the ins and outs of real estate, and now you want to invest in REITs when you know nothing about. As they say, when a man with experience meets a man with money, the man with the experience ends up with the money, and the man with the money ends up with the experience. As said, REITs done really well over the last 30 years because interest rates went down. Now that interest rates are going down, this might change, and we already see these declines here that might be ugly for REITs for the next few years. And then, yes, some REITs are great, some REITs are not that great, but usually the REIT that is great will also be pricey, and the REIT that is not great will also look cheap, but it might also do very, very badly. And speaking of those that own all their assets into real estate, look at this. REITs went nowhere for 5 years, but look at what happened at the housing market over the last 5 years. So in the Netherlands, it almost doubled. So you made your money with real estate compared to REITs. The thing is that REITs are levered vehicles that want to push that stock price higher, where the management wants to have a bigger and bigger plane, and they will keep doing their strategy no matter how intelligent it is or not. They will just push it, push it, push it. Now everyone is focused on to logistics, etc., other things, or elderly care homes, or this, and those prices are high. So the market is pretty fair there and priced in. Thus, the conclusion is, when it comes to REITs and real estate, mind the cycle, mind the interest rates, and you have to know that the outlook now isn't as positive. It was better every year in the past than it is now. Yes, if you own real estate, it is good inflation protection, but REITs are risky in general, and if not risky, then pricey. Watch interest rates. Try to get a fixed mortgage, but even now, if those interest rates are low, if interest rates are 7%, if you must buy, maybe risk it with a variable. I'm not smart at this moment in time, especially when I see these things. It is pretty risky to buy something. If you own something like my mother owns a rental property here in the Netherlands, she's happy with her 4 or 5% return, everything great, and she doesn't touch it, forget about it. But buying now something to have a return might be not the smart risk and reward situation. Of course, anything can happen, but you never know. And the thing is that stocks are down, real estate is not down yet because of the lag. So now it might be time to buy stocks, and when things improve, stocks will rebound much faster, like it was the case from 2009 to 2014-15, and real estate prices just started to turn there. So you could have made your money in stocks and then switch to real estate when it was cheap. I did that in that period of time. I guess that's risk and reward, just thinking about investing. The solution, as I said, stocks react faster, thus the opportunities are with stocks because those are already down and will likely react faster on the upside, especially if you do it well. And then when stocks are higher, then you might want to look again for real estate. Okay, let's discuss hedges. The truth with hedges is, now that we have seen volatility and everything, that most of those are pricey. So I looked at the S&P 500. If you want to protect yourself with a put, the cost of that put per year is 7.8%. It used to be even 4% the last time I was looking. So the hedges there are pricey, and as stocks are already down, perhaps the best hedge is just to buy great businesses at fair prices. But then, yes, you have to accept the volatility. If you can't accept the volatility, short term bonds for the money you need over the period of time you want to sleep well. Now, next asset class, land. Do you want to buy yourself some land? There is inflation. Land gives you protection against inflation, right? So, a piece of land, as they say. But the problem is that if you get a piece of land, that's it. You get a piece of land and it doesn't produce much, or you manage it actively, it is something on it that you rent out or something like that, but that is where you get paid for managing it or something like that. And my parents have a property, piece of land here, you can build on it, but what's very interesting is that I compared what you could buy 20 years ago and what you can buy now for that piece of land. And you can buy an apartment now as you could buy an apartment 20 years ago. The problem is that there was no yield for 2 decades. And if you had some yield and if you rented it out and then invested that over time, now my parents would have at least 2 apartments, but the piece of land sitting there idle is just one. And then, of course, if we look at land prices, again, people rushed to it when it was higher. Now it is lower, and then you again have to see what is the yield there, how much are you willing to pay for it, and whether it fits you. I would say that it is better to look at cash flow as a solution, be an investor, because whatever happens, you can have, yes, inflation protection, but on top of that, cash flow, and that is the long term better solution, I think, if you're not active rezoning like we did in SimCity or things like that. Now, commodities. I know a lot of you love commodities, and if we look at the commodity index, we have seen this boom in 2020 and 2021 on inflation, and this is now deflating a little bit, but you have to just keep in mind commodities are priced on real demand and supply and on short-term trading. Nobody's long-term liquid to trade long-term. Therefore, you have to buy them. This is iron ore. There is a lot of volatility because the traders follow the trend, and therefore you have these booms and busts. But as I discussed in this copper video, you have to see, okay, understand the commodity, what drives it. But in general, when it comes to commodities, and when I look at this price, give me a good recession, and then I'll be the first one to look at specific commodities, all of them, and then look at those that work best. Because at some point, the cash cost of production, commodities usually bottom, and that's a low or no risk time to buy. Now we are high risk, maybe some return, but likely lower return. So forget about commodities until we have a good recession. We already discussed this a lot, but value as an asset class here. To discuss that, we need to know what is value. And when it comes to value, I think that if you can get 4% from the treasury, if you're an investor, you need to get more now plus other things. Value, I think, is something that lives with inflation. So you look at that and then you say, okay, if there is inflation, it gives me protection. I can increase prices if there is inflation, thus my margins stay there or even increase and I make more money. Has a return double than the treasury. So if the treasury is 4%, if we're looking for value, we have to already look at 8, 7, 8, 9%. And then something that grows too. And then if you want to really push it a level higher, you say, okay, I also want a margin of safety where I know that long term I will not lose my money. And if we look at a business like Google, that is also in our YouTube portfolio, yes, they can increase prices. The PE ratio is 20, that's 5% per year. if they grow 10% per year or 5% per year, then that is 10% plus inflation. So nothing wrong with that. The only problem is that there is no margin of safety from a book value because it is an asset light business. But if you can accept the volatility and accumulate more of a good business when prices are down, and if those go lower, you're simply happy to buy more, then I think that investing in businesses can be one of the best solutions accumulating wealth in 2023. And yes, anything can be valued at the right price. So all these asset classes that we discussed will be great opportunities at some point in time. Maybe over 2023 things will change there, but for now, only accumulation of businesses is what looks like the smart thing. If we look at alternatives, if we look at Goldman's definition, it's private equity, private credit, real estate, infrastructure, sustainability, liquid alternatives. I think that all these have boomed, and like real estate, there is a lag there. So if you really don't know what you're doing, and if you're not Horowitz of Anderson or Sequoia watching this, then you don't know. Thus, the golden age there has passed, and therefore, when it comes to alternatives, I would be very, very careful because YouTube boomed with watches, cars, art, whatever. But let me show you something. So, this is somebody selling some art masterworks, and look at their email, and I'll tell you what I read when I get these offers to sponsor something. This is anti-sponsoring, so don't think I'm making a buck here. A platform investing in multi-million-dollar fine art names like Banksy, Basquiat, and Monet. We are the first company to securitize a painting, and now we have 200,000 users and 60 plus works. We've actually become the largest buyer in the art market, acquiring 400,000, which means they overpaid for everything. They are the largest buyer, thus they pushed the prices. They were the idiot, the greater fool, paying for higher, and they want me to sponsor them to get more money in so that they can push those prices higher. When people say no to these things, then you know what's the end of these projects. And yes, 2020, 2021 worked really well, but if they have to start doing things, ow, ow, ow. Just to show you the backside of how things work. Now, let's discuss more diversification, something that Ray Dalio says that we don't know where assets will go, but we can diversify. And if I have to invest in all of these, let's just look at them. Bonds, very bad. Gold, risky, we have no idea where it will go. Crypto, the greater fool. Real estate, very risky now. The highest risk for real estate is now. Hedges are pricey. Land, if you can grow weed on it, land grows usually weed if you leave it, but not the kind of weed that can make you money. Commodities, wait for a recession. Value is always good. Alternatives are stupid. And diversification daily, therefore, with yes, you will do okay, but Ray Dalio didn't beat the market. So again, investing in businesses long term might be the right thing. We are left with emerging markets that have the best return here. Emerging value last year they were, but keep in mind, they again crashed 50%. So now their expected return has doubled, but that is short-term sentiment. Now they expect again that avoid US delisting, government pledges policy support. So it might be great there, but you never know, and you have to see how it fits your portfolio. My conclusion for the next decade is this is the best time to accumulate wealth by accumulating businesses. Accumulating means buying over time, building a portfolio of value, and then if you can add thinking about margin of safety, then you can do great. Next video will be about buying now that value immediately or wait for a 2023 recession And there is a framework that I will give you there so you can enjoy that into the next video. See ya!